Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about BRIDGEBIO PHARMA INC quarterly report. BRIDGEBIO PHARMA Inc. offers a range of transformative medicines for patients with genetic diseases and cancers. The company's portfolio includes Attruby, a treatment for cardiomyopathy caused by transthyretin-mediated amyloidosis, low-dose infigratinib, a treatment option for children with achondroplasia and hypochondroplasia, a skeletal dysplasia, encaleret, a treatment for autosomal dominant hypocalcemia type 1 BBP-418, a treatment for limb-girdle muscular dystrophy type 2I/R9. The company also develops products for Mendelian, oncology, and gene therapy diseases. Additionally, BRIDGEBIO PHARMA has partnerships with various organizations through license and collaboration agreements, including Election Pharma International Operations Unlimited Company, Leland Stanford Junior University, Leidos Biomedical Research, Inc., and Novartis International Pharmaceutical Limited. BRIDGEBIO PHARMA Inc.'s stock skyrockets by 170.7% in a year. Key drivers behind the surge: the remarkable growth of BRIDGEBIO PHARMA Inc.'s stock price can be attributed to several significant events and developments that have taken place over the past year. The company's stock has skyrocketed by over 170.7%, with its 52-week low reaching $21.72 and a high of $69.48. The FDA approval of Attruby, acoramidis, for ATTR-CM in November 2024 was a major milestone, propelling BRIDGEBIO into a commercial-stage organization. The successful commercial launch of Attruby has generated significant revenue, exceeding analyst estimates, with $108.1 million in U.S. net product revenue in the third quarter of 2025. Additionally, positive Phase 3 results for BBP-418 in limb-girdle muscular dystrophy and encaleret in autosomal dominant hypocalcemia type 1 have further boosted investor confidence. These late-stage clinical trial results demonstrate the company's pipeline strength and its ability to deliver innovative treatments. The strategic monetization of European royalties for $300 million upfront payment has also contributed to the company's financial stability, providing liquidity to support the launch of Attruby and other late-stage pipelines. These consecutive positive developments have been the primary drivers behind BRIDGEBIO PHARMA's substantial stock price increase over the past year. The primary drivers of revenue growth for this biotechnology company are multifaceted. Commercialization strategies for acoramidis and development of other product candidates have contributed significantly to revenue growth. Additionally, royalty payments from licensed products in the European Union and net sales of licensed products under the Bayer license agreement have also been key drivers. Notable milestones such as FDA approval of Attruby TM and regulatory milestone payments from Bayer have further boosted revenue. The company's diversified revenue streams, including net product revenue, license and services revenue, and royalty revenue, have also contributed to its growth. However, the company faces risks related to dependence on single-source suppliers for drug substance and product manufacturing, which could impact business if suppliers experience significant challenges or failures. Despite these risks, the company's strong commercialization strategies and diversified revenue streams position it for continued growth. Net income and profit margins. A tale of contrasting trends, the net income of the company underwent a significant shift in the 9 months ended September 30, 2025. Initially, it increased by $75 million due to the recognition of a regulatory milestone payment. However, this positive trend was overshadowed by an overall increase in net loss by $262.3 million from 2024 to 2025. Profit margins also presented a mixed picture. Although not explicitly stated, they were implied to be negative due to substantial operating losses. The company's revenue recognition policies further complicated the situation. License revenue was recognized at a point in time upon transfer of rights and control, whereas research and development services revenue was recognized over time using an input method. This disparity likely contributed to the company's struggling profit margins. In summary, while net income experienced a brief surge due to a regulatory milestone payment, it ultimately declined alongside increasing net losses. The company's profit margins remained under pressure, with negative implications stemming from its complex revenue recognition policies. The company's financial performance indicates a mixed picture regarding its operating cash flow. While there are instances of negative operating cash flow, particularly for both periods as stated on page 7, other information suggests that the company is generating positive operating cash flow. Specifically, it has reported $32.1 million in net cash provided by operating activities for the 9 months ended September 30, 2025, page 41, and $4,757,000 for the 3 months ended September 30, 2025, page 42. This inconsistency may be due to fluctuations or specific periods of performance. The company's debt level and interest expenses have shown mixed trends over the past year. While total debt has increased from $2,376,950 to $2,920,979, indicating an upward trend. Cash paid for interest decreased significantly from $78,236,000 to $43,670,000. Additionally, interest income has increased by $2,943,000 and $2,956,000 for the 3 months and 9 months ended September 30, 2025, respectively. However, interest expense has also shown a decrease of $11,322,000 and $28,002,000 for the same periods. These contradictory trends make it challenging to determine whether the company's debt level or interest expenses have changed significantly. Management's outlook, focused on commercialization and revenue growth, the company's management is optimistic about its product candidates' potential to capture a significant share of the market, with estimated annual sales of at least $1 billion. However, they acknowledge that the company will continue to incur operating and net losses for several years, as it focuses on commercializing products such as acromedies and other candidates. A key strategy is generating revenue from these efforts, which is expected to be supplemented by growing cash flow from partnerships like Kyowa Kirin and recurring sales of Atrubby starting in 2025. Management's investments in marketable securities and intangible assets are also seen as a means to support this growth. Despite potential risks, the company remains committed to translating research into products that can reach patients quickly. The company has made several key transactions in recent times. Notably, it acquired the Bayer license agreement through an implied acquisition by BRIDGEBIO PHARMA INC. And entered into the KKC agreement for $100 million upfront payment to license transfer and research services. Additionally, there are indications of exploring opportunities to divest or delay certain research programs, although no explicit divestitures were mentioned in the report. The company also repaid a term loan under an amended financing agreement, which could be considered a divestiture of debt. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In recent years, the company declared special cash dividends in 2024 and 2025, totaling $28,984 per ordinary share. Additionally, it repurchased common stock for $48.3 million in 2025, indicating a commitment to returning value to its investors. Concerns about inventory buildup or supply chain disruption exist. There are valid concerns regarding inventory buildup and potential supply chain disruption. Several risks have been identified that could impact the company's operations. These include product returns, chargebacks, and government rebates, which can lead to financial losses. Additionally, regulatory changes by the FDA may affect manufacturing processes and approvals, posing a significant risk. The reliance on third-party manufacturers also introduces potential issues such as breach, misappropriation, and termination of contracts. Furthermore, contract manufacturers' inability to meet regulatory requirements and quality control standards could result in supply chain disruptions. The company's single-source suppliers for certain products increase the risk of supply disruptions, which can have severe consequences on inventory buildup and overall operations. These concerns highlight the need for careful management and mitigation strategies to minimize potential risks and ensure a stable supply chain. That concludes the financial summary for BRIDGEBIO Pharma Inc. Feel free to comment below, and I will be happy to answer them when possible.